The IMF's assessment is that the major economies have stabilized, and next year the world should see modest growth. And therefore, Singapore should also see modest but positive growth in 2010, which is good news. But I would like you to bear in mind the possibility of something not so happy happening. We don't think it will happen, but it could go wrong. And why can it go wrong? Because the growth you see in Europe, in America, to a lesser extent in China, is because of government spending. The government is printing money, is just distributing vouchers, credits, reducing taxes, encouraging people to spend, buy cars, buy electronics, washing machines, whatever. It feels good while it lasts, but when it runs out and the stimulus ends, the economies may slow down again. And if their economies slow down again, our growth will also dampen. So we have to bear that in mind. We also have to bear in mind that in any case, our unemployment is likely to stay up for some time. Whether we grow next year or whether we have a very slow, difficult year next year, our unemployment is not likely to come down quickly. Second quarter was 3.3%. We thanked our lucky stars. It was only 3.3%. In the short term, 3Q, 4Q, it may well rise higher than that. We don't have the numbers yet. We'll have them by the end of the month. But it may well go up. Because unemployment numbers tend to lag economic recovery. When business comes back, employers want to be absolutely confident that the business is really up, that the economy is really going to sustain its growth before they start hiring again on a big scale. So the U.S. unemployment now is nearly 10%, and they expect it to go above 10% next year. Europe, too, unemployment is up. So we must expect some impact on us in Singapore of these overall economic conditions. Therefore, we have to be psychologically prepared for dampened growth or any way for unemployment to stay high. This is the backdrop against which we have to decide what to do with our special measures in the resilience package. 3 of them, which we have to think about: SPUR, the Special Risk Sharing Initiative, and of course, Jobs Credit. SPUR is the easiest to discuss because it's a 2-year program. It has 1 more year to go. We will let it run for this full 2 years because it's the right program, and we will continue to need job training and upgrading, whether it's a recession, whether it's a boom, whether the economy picks up faster or slower. And we must therefore continue to incentivize companies and also incentivize workers to upskill, reskill, and multi-skill. In fact, we have to redouble our efforts as we come out from the recession, because in the longer term, I think the challenges are going to be greater, which I will talk about again later. The Special Risk Sharing Initiative is a scheme to encourage banks to continue lending money to businesses even in a downturn and not to pull back all their lines. It's helped us to maintain the loans to companies and has kept many SMEs afloat who might otherwise have crashed even though their business was fundamentally okay. I think now that conditions are more normal, banks have become more willing to lend to companies. But there's still some uncertainty, and in some sectors, companies are still having difficulty getting financing. The scheme runs until January, so we have a bit of time. We will monitor the situation before we decide what to do. But whatever we do, whether we continue it, modify it, alter it, the government will continue to support companies to have access to credit. Thirdly, jobs credit, which I think is what unionists are most concerned with. The scheme has done its work. It's held retrenchment down and unemployment numbers down. The final payment of the jobs credit will be done in December and is based on October payrolls. That means payroll this month will determine the final payment of the jobs credit, which is in December, on the present scheme. This was an extraordinary response to a grave economic crisis. Strictly speaking, after the second quarter numbers, after the third quarter numbers, with the global situation, the jobs credit is no longer needed because the economy is recovering and some companies are hiring again. But if we withdraw the jobs credit suddenly and completely, I think companies may have some difficulty adjusting. So we talked to employers and unions to get a feel for their sense of what the situation was. And both sides, employers as well as unions, understood the need to withdraw the jobs credit, but they hoped to be given another few months. So we've carefully considered all these views and we've decided what to do. We will extend the program for another half year. Two more payments, but on a stepped-down rate. The current rate is 12% of salary, subject to a cap of 2,005 on the salary. So there will be two more payments. First payment, based on employees on the payroll in January 2010, and the payment will be at half rate, 6% of salary. And the second payment, which is based on employees in April 2010, which will be at 1/4 rate at 3% of salary. It's two extra payments, and it's not cheap. It is going to cost the government $675 million. Question is, how are we going to pay for this? The jobs credit, we funded from past reserves, and we got the President's permission and the CPA's permission to spend the money from the past reserves. Because at that time, we were facing the bleakest outlook we had seen since independence, at least economically, and so we felt it was justified, and the President agreed with us. This is no longer the situation today. Therefore, the two new jobs credit payments we will fund out of the normal government budget. We have not asked the President, and we have informed the President that we are going back to regular government financing. This is back to normal economic management, and I think the government should take responsibility. We appreciate that not all companies are out of the woods. Some SMEs are still concerned about business conditions. Some industries are still under pressure. And also unemployment, as I explained, will take a while to come down. But we have to see these issues in totality of the whole economy and of the measures which we are taking. The jobs credit is not designed, not meant to help specific companies or specific industries. In particular, is not meant to help weaker companies instead of stronger ones. It's an across-the-board relief to lighten the burden for everybody, necessary in the middle of an exceptional crisis. Now that the crisis has passed, we need more targeted measures to support economic restructuring and to enhance productivity. Last week I was in Tokyo. I visited the Keidanren, which is the Employers' Federation equivalent to SNEF, of course much bigger, and met some of the senior businessmen. One senior Japanese businessman asked me a very penetrating question. He put it very politely, because the Japanese always put things very politely, but he knew exactly what he wanted to ask. He said, "You are encouraging companies to hold on to surplus workers, underemployed, but holding on to them to keep unemployment down. But at the same time, you talk about promoting innovation, creativity, productivity. You got Biopolis, Fusionopolis, R&D. How can you get all these new activities and all this productivity if companies are holding on to surplus workers? So I explained to him, I said, well, holding on to surplus workers is a short-term measure. The economy has plunged. We don't want companies to cut all their workers immediately. Let's hold on, see what happens first. But even then, we didn't just have jobs credit. We also had Spur to upgrade the workers during the slack period. And we didn't just have these temporary first aid measures. We also formed the Economic Strategies Committee to work on strategies for the longer term, things which he was referring to, R&D, biomedical, and so on. With the jobs credit, we helped to stabilize the unemployment. We helped to stabilize the overall situation, and therefore we could pursue innovation, train the workers, and develop longer-term strategies. So the Japanese businessman was absolutely right. If we needed a jobs credit in the emergency, but if we keep it for too long, it will delay restructuring which is necessary, and it will discourage workers and other resources from being moved from companies which are less productive and need them less to companies which are more productive, which are growing, which need them more, and where they can make a contribution and where they can do better for themselves after the transition. We cannot prosper again and sustain our growth by keeping workers underemployed and underproductive. In the longer term, we have to pursue higher productivity, build capabilities, and move workers from the less competitive businesses into the newer, more competitive, expanding businesses. In other words, we have to foster restructuring. We cannot hold back restructuring. We cannot freeze our economy where it was in 2007 before all these problems started. The Economic Strategies Committee is working hard. It will have recommendations in time for the budget next year. And the budget will have measures and programs to support companies' efforts to grow, to innovate, and to compete based on higher productivity and better performance. And the measures and the programs will reward the firms which are best able to spur job creation over the medium to long term. And that will be a better approach to sustain our growth than to continue with the emergency measures for too long. Given this global situation, we expect to see slower growth over the next 1 or 2 years. But beyond that, the prospects for Asia and for Singapore are bright. There are many positive factors for the Asian economies: low costs, improving infrastructure, and hard-working, talented, hungry people. People who want to do better, who are working hard for themselves, who want to transform their economies, and who create opportunities for us in the middle of Asia. So Singapore has many positive factors too. Not just our location, but also because we've impressed others by the way our workers have stayed resilient and flexible, the way we've responded decisively and effectively, and avoided politically popular but damaging actions which would have hurt ourselves. And by the way, Singaporeans and unions have supported the measures and given their confidence to the government. And so we've reinforced our reputation as a stable and conducive place to do business. And people are noticing. For example, there was a French business delegation in town in August, and earlier this month. It was a French bank, Crédit Agricole, and they brought 30 of the French companies here. And the chief economist came with them, Jean-Paul Bézet. And he explained why they were here. He said, Singapore is tipped to be one of the winners in this new financial world order because companies are looking for clear, neat, and consistent rules and good regulators implementing them, especially financial service companies. You need to know what the rules are. You need to have confidence in the regulators and the government to be honest, capable, and not to change the rules on you. People now want to be in a safe place for banking and finance. And he said, well, Singapore will face competition in Asia, especially from other financial hubs like Shanghai and Hong Kong. But Singapore still occupies a crucial niche as an alternative to these two other cities, which are more Chinese-centric. And that's what other business people tell us too. I met one multinational who's moving his big global headquarters here, and he said he's got an office now in Hong Kong, but very difficult to persuade them to spend any time thinking outside of China, because China is such a big opportunity. If you are in Hong Kong, you're focused only on China. But if you're in Singapore, China is still there, but the rest of Asia is there, the rest of the world is there. Singapore is a good place to be. And another thing which is going for Singapore, according to this French economist, is that we've successfully established ourselves as a double hub, a center for exports as well as one of the key financial capitals in Asia. So we've got finance, we've got manufacturing, we've got services, we're exporting, as well as doing financial business. And so French companies are using Singapore as a springboard into the region. So therefore, even now we are getting companies come to Singapore and new jobs are being created here.